Welcome back. Thanks for watching another video. So in this one, I'm going to take a different approach, and I might create a separate series. I read a lot of different IRS court cases, and at times it's very humorous on what people and companies try to get through to the IRS, by documenting or undocumenting certain transactions on their tax returns. And when we work on tax returns for individuals and for businesses, we're pretty conservative, and we remind them, hey, if you do this, more likely you're going to get audited, and that you can't take this deduction. Well, in this video, I'm going to go through 3 examples. They're all real life. They just happen, and in each one, the IRS says, nope, you can't do that. You got to pay tax on this. And these are examples that I've seen in the past that people have kind of asked. And that's why I kind of wanted to create this video here, where these are almost like commonly asked questions. Can I do this? So, and there's also a lot of misinformation out there on TikTok and some of these other platforms that I wanted to make sure that everyone kind of sees what you can do and what you can't do. So if you have any questions, leave them in the comments below. And again, I'm going to create like a series on these as I kind of find more cases that are relevant to most companies, business owners, and individuals. Thank you again for watching. Okay, so this is a platform I use. This is kind of like a whiteboard, a virtual whiteboard. I'm going to kind of just go through the 3 examples. So in the first one, what happened was this individual, they took out a loan from a bank, and it was for the business, and they're going through some hard times, and eventually the bank said, you know what, we're going to forgive the loan. Okay, you're not going to have to pay it back. And years went by, and eventually, and this was, by the way, it was a single member LLC. Okay, so if you remember from my past videos, those are business owners that report their income and expenses on Schedule C on their personal return. So this business owner takes out a bank loan, doesn't pay it back. The bank says, don't worry, we're going to forgive it. Years go by, the bank sends him this tax form. It's called a 1099-C, cancellation of debt, or you'll hear like COD. And he decides he's not going to put this on his return. He's not going to report it as income. Well, if you ever get any tax form, whether it's a 1099 MISC, a 1099 NEC, any tax form that you get in the mail, another copy goes to the IRS. So it's kind of like a checks and balance. So when you get it, the IRS is going to get a copy. When the IRS gets a copy, they expect that you are reporting this on your tax return. Well, this business owner doesn't record it, and it was about $30,000. And the IRS comes back, audits them, and says, you know what, you got to pay tax on this. And that's what happens whenever you get a 1099-C, cancellation of debt, or another way of saying this, if you ever had a loan and it gets forgiven, most of the times that forgivable loan is taxable to you. So you got to keep that in mind on loans that are forgiven. Now, during the whole PPP, you didn't have to pay back. This is money that was given to companies. You didn't have to pay it back, and there were certain standards that the IRS kind of talked about regarding PPP loans. But this was a true bank loan that this business owner received. So just be on the lookout, and just keep in mind whenever you get a bank loan or any type of loan that gets forgiven, it's a taxable event. So here's another interesting one. You got an S corp. Okay, we'll call it company XYZ. And it's owned equally by 3 owners. Okay, owner 1, owner 2, owner 3. So 33%, 33%, 33%. And this business that they ran did not have a central office. Okay, so what they were doing is they were having meetings at each of these individual homes, right? And there's a rule where if you can rent out your home, okay, and if it's under 14 days during the year, you don't have to report that as income. Well, this company paid each of these owners, well, I guess in total, so each of these owners received about $100,000. So the company paid $100,000 to each of these owners for rent, for having these meetings at their homes. The company recorded a rent expense, so they deducted that. Each of the owners recorded, the $100,000 of income, and they never reported that. They didn't claim it as income. And, the IRS kind of saw all this going on, right? And, they were seeing kind of money kind of going in and out, and they get audited, right? And what turns out is the IRS says, nope, you can't do that. Of the $300,000 deduction, we're only going to allow $10,000. So if you can imagine, here's a company that was doing this, and now they can only deduct $10,000 instead of $300,000. So just be careful on how you factor in, like the home office, right? Where are rent payments going to? Part of this is correct about the 14-day rule. And the company really didn't have an office, so it's not like they couldn't deduct the rent. It's just the matter of how they were doing it, how they set it up, and the court case didn't go into the details on how they came up with $300,000, but I mean that's $290,000 that they can't deduct anymore. And assuming that the company was profitable, they're going to have to pay tax on that. So that's example number 2. And the last one is one that I tell every business owner that has a partnership and even an S-Corp. It's the whole concept of tax basis. And for S-Corp owners out there, the IRS now requires a tax form to be shown on your personal tax return because they want to know what your tax basis is in the S-Corp. Because if you're in a loss position and you don't have tax basis, you can't use those losses to offset other income. That's what a lot of business owners think. Hey, I got all these losses. I can just use those losses to offset other income. That's true, but you got to have tax basis. Okay. And in this example, again, another true story. There's a couple, husband and wife. They own a few partnerships and they had a bunch of losses from prior years that were going to carry over to offset some other income this year. And they claim they had tax basis because the owner created this promissory note where he gave the business this loan. It was a pretty substantial loan. It was like $2.7 million. And the IRS says, nope, you don't have any basis. The debt wasn't bona fide. So we see this so many times where business owners kind of just put in money and they treat this as a promissory note. There's no documentation. There's nothing. And they think that, most business owners are not that familiar with tax basis, but once they understand it, they think that their note becomes tax basis. Well, in this case, it's not. And what happens is those losses, this couple tried to offset other income, was disallowed. So again, the whole tax basis thing, here's like a simple example. You start a business, you put $10,000 into it, okay? And just say it's a partnership. You put $10,000 into it. So your tax basis is $10,000. It's a positive $10,000. After year 1, the company has a loss of $9,000, okay? That $9,000, it's a loss. Losses reduce basis. So you started out with 10, you have a loss of $9,000. Now you're positive $1,000. That since you're positive still at the end of the year, that $9,000 of losses you can use to offset other income on your personal return, assuming this is an active trade or business, because you have basis, okay? And then you go into year 2, your basis starts out at $1,000, and just say you have $7,000 of losses. So now your ending basis is $1,000 plus, less the $7,000 of losses. Now your basis is a negative $6,000. So you don't have basis because it's negative. So whenever you hear, the person doesn't have basis, that means it's below 0. So in this, for year 2, the business owner can only deduct $1,000 because that's, because after 1,000, everything goes down to, goes below 0. So it's really important for business owners to understand this, and it's easy to keep track of this basis once you start a business. And here's like another thing kind of going into the whole accounting records and everything, keeping your accounting records tight and in good shape and all updated on a monthly basis. In a way, the equity section kind of loosely in a loose area, I can kind of keep track of some of this for you. So anyways, these are 3 court cases, all true stories, all recently happened. And I'm going to create a series kind of going through these that I find that relate to, business owners or individuals that we work with. So any questions, leave them in the comments below. Thanks again for watching.